Strategic report. Seller carryback as a convertible note rolled into NewCo executive summary. This report outlines a financing structure in which a seller-financed carryback is formalized as a convertible note and rolled into the buyer's NewCo balance sheet. This approach transforms a traditional debt instrument into a strategic asset, benefiting the seller through interest and equity upside, the buyer through reduced cash outlay and enhanced credibility, and the lender through improved capital structure and borrower commitment. 1. Structure overview. Transaction type: asset or stock acquisition. Seller carryback, 30% of purchase price, structured as a convertible note. Note terms: 5-year term, 8% interest, convertible into preferred equity at buyer's discretion. Conversion triggers: revenue milestone, time-based trigger, or buyer election. Balance sheet treatment: initially booked as a long-term liability, convertible into equity upon trigger. 1. Advantages to the seller: interest income, earns 8% annually, secured by inventory and IP equity. Upside: optional conversion into preferred equity at a pre-agreed valuation. Tax deferral potential: may defer capital gains if structured as reinvestment under IRC Section 453 or Section 351. Legacy participation: retains a stake in the brand's future without operational involvement. 1. Advantages to the buyer: reduced cash requirement, preserves liquidity at close while satisfying lender equity injection rules. Skin in the game optics: seller note treated as buyer's equity injection, boosting credibility. Control preservation: no dilution until conversion, buyer retains full operational control. Strategic flexibility: option to convert or repay based on performance and capital needs. 1. Advantages to the lender, for example SBA or other lenders: improved capital stack, seller note counts toward buyer's equity injection if subordinated and on standby. Borrower commitment, buyer's use of seller financing signals confidence and reduces default risk. Asset-backed security, note secured by tangible assets, inventory, IP, enhancing collateral base, balanced risk profile. Convertible structure aligns seller incentives with business success, reducing friction. 1. Accounting and reporting considerations. Initial classification: long-term liability on NewCo's balance sheet. Accrued interest, tracked separately, impacts income statement and equity via retained earnings. Conversion event: liability reclassified as equity, improves debt-to-equity ratio and lender optics. Valuation mechanics: conversion price tied to post-money valuation or fixed formula. 1. Strategic framing for stakeholders. This isn't just seller financing, it's a reinvestment. The seller becomes a passive stakeholder in the brand's next chapter, the buyer preserves capital and control, and the lender sees a committed, well-capitalized borrower. Everyone wins.